We're going to begin by covering depreciation first. One of the first things we need to do is determine the cost of the asset. The asset's cost would be the purchase price plus all expenses needed to prepare the asset for use. For instance, let's say I wanted to make a food truck. I could purchase a box truck. I need to brand it, put my logo on it, put the menu on, maybe make any repairs if it was used. I need to prepare the inside for use for the business by setting up stations. All of these costs would be part of the asset's cost, the purchase price, because we're preparing it before its initial use. For purposes of this class, I'm pretty much just going to tell you what the cost of the asset is, but I just want you to know that it's not just what we spent on it initially, but it's also the other expenses getting it ready for use. I do want to point out that land is not depreciable. We're not going to depreciate land. That's something we do not do in accounting. Assets that we do depreciate would be buildings, machinery, equipment, furniture, vehicles, those types of assets. Remember, these are assets that are going to last many years. We're not going to use it all up in 1 year. As a reminder, depreciation is a process of allocating the cost of that asset to expense in the accounting periods we're benefiting from its use. This means if we buy a car for $50,000 for a business in the first year, we're not going to expense it all in 1 year if we expect to use it over multiple years. Instead, what we are going to do is take that $50,000 expense and allocate it over the years we're going to be using that item. Remember, we are not revaluing the item. We're not seeing what it's worth. We're just taking whatever we spent on it and allocating it over its useful life. And we use estimates for this. The items we need to calculate depreciation are the cost of the asset, which I just went over, the salvage value, also known as the scrap value or residual value. This is what the asset would be worth at the end of its life, the scrap price we can get for it. Or if we sold it, what we could sell it for. And the last item would be the useful life. How many years we plan on using the item for. Remember, it is just an estimate, and I'll always give you those numbers. There are going to be a few different types of depreciation methods we're going to use. We do need all this information, and for one of the types, we would need additional information besides this. Like I said, there are 3 methods we're going to be covering. The first one is the straight line method. The second one is the units of production or units of activity method. And the third one is the declining balance method. We're going to be doing the double declining balance method here. Let's start with the straight line method. This is the easiest method. It's also very commonly used. This is when we depreciate the same amount every single year. That's why it's called a straight line. It's the same amount. The formula for calculating this would be the cost minus the salvage value divided by the useful life. When you do this formula, you will get the depreciation expense every single year, and it would be the same amount each year. For example, with this car example I used, the $50,000 expense over 5 years would be $10,000 each year. I'm sure there will be a residual value for this car, but this is just a simplified way of showing you how this method works. As a reminder from chapter 3, the journal entry for depreciation would be a debit to depreciation expense and a credit to accumulated depreciation. And then you would put the name of the asset in. In this case, I just put machinery, but it could be vehicle, equipment, furniture, building, that type of thing. The next one we will look at is units of production method, also known as units of activity method. The formula would be cost minus salvage value, which was the same as the straight line method, divided by total units of production or total units of activity, which I like to use, times the current units of production. Total units of production would be the total over the whole life that you can get out of it times the current. For example, if I get a car and I know at 100,000 miles, I'm going to get a new car. The total units would be the 100,000. I'm going to use 100,000 miles over the life. And then I would multiply it by the current year's miles. This year, I only drove it 10,000 miles. So I would do times 10,000. When you do this method each year, only the current units of production would change. Each year, you will multiply it by the amount of miles that you drove that year in the example of a car. This first part would not change at all throughout the years. We would keep that as is, and we would only change this multiplication part, the current units of production. The last method is the double declining balance method. This method is very popular when depreciating assets on tax returns because we are taking more of the depreciation expense in the first few years of the asset and less later on. Therefore, you get a bigger deduction in the first couple years. It depreciates at a rate double the straight line method, which is why it's called the double declining balance method, because it's double the straight line method. We need to figure out the depreciation rate. Like I said, it's double the straight line method. To do this, you would do 1 divided by how many years you're going to be using the asset for. That would give us the depreciation rate under the straight line method. Then we would multiply by 2 so that we could double it. This gives us the depreciation rate. Once we have the depreciation rate, we will multiply that by the book value to get the depreciation expense each year. This one works a little differently because once we get the depreciation expense for a year, we will update the book value and do the depreciation rate with the new book value to find the new depreciation rate. Then the next year, we would do the same thing. The book value would be updated. We would subtract depreciation from the year before from it, and then we would apply it all over again. There's a couple other considerations I would like to point out for depreciation. We're just really doing full year depreciations, but depreciation can be done in a partial year, meaning that if I did not buy my asset in January, maybe I bought it December 1st. If I bought it December 1st and my year ends December 31st, I wouldn't depreciate it for a whole year. I would only depreciate it for 1 month. So be mindful of the dates that these assets are bought. If it's bought in January, you'll do a full year. But if it's bought halfway through the year, you only do half a year's worth of depreciation. If you buy in October, you're only due from October until December. You wouldn't do a full year. Another thing to be mindful of is that when estimates change in depreciation, because a lot of our information is based on estimates, we can revise our depreciation schedule. For instance, if I want to make the useful life shorter or longer, or change what the salvage value is, I can do that. You would stop in the year you decide to change this, and then you would redo the math and finish out the rest of the depreciation schedule based on the new information. That concludes the depreciation portion. Hopefully you understand those 3 methods.